Hey everyone, welcome back to the Mark Loeffler Experience. Kellan James again. We're going to be talking about joint venture versus not. So I don't know if this is going to come to fisticuffs, but we're going to talk, we're basically going to go all reasons why I joint venture and why he doesn't. And we're going to go through pros and cons of each.
I found it interesting because I think how this kind of came up was I had done a post about joint venturing or not, and then you were like, hey, I might be kind of looking to get out of the whole joint venture thing. And I'm not sure where that stands at this point.
Well, yeah, I mean, obviously everyone knows I'm selling 140 units right now in Hamilton. I think we've sold 5 out of the 7 buildings already. I mean, obviously they're good assets. They're going to go quick.
Oh, yeah.
That was my intention was, I would just pick up other buildings by myself. And then, and I always say this, always whenever I say something like that, it comes back to kick me in the ass. Because I have an opportunity to buy 100 units in 2 buildings in like a quadruple A location.
Yeah.
Like it doesn't get any better than this location.
Yeah.
Like this is like a legacy asset. Obviously the quadruple A location, like it's $400,000 a door. Like this is not cheap. Like I'm selling in Hamilton at 220 to like between 190 and 220.
Yeah.
And like this is obviously big money, right?
Yeah.
Even with selling off all my stuff, I can't swing a $40 million deal by myself at this moment.
I think that's the big thing, right? Is like my portfolio, I have 52 units right now, so nowhere near where you're at.
Yeah, worth about 10 million, right?
It's like 7 or 8 or something like that. Yeah. So solely owned, and I love that structure. I mean, it's my favorite way to structure things, but I don't think it's ever makes sense to not do a deal if you can't do it. If you can't do it yourself, but you have the opportunity to take on an amazing project you wouldn't otherwise be able to take on, of course it makes total sense, right? And the way that people structure things, joint ventures can be great. I mean, typical structure is, the passive partner, the money partner is going to be bringing usually all of the money in order to finance the deal, down payment, closing costs, and renovations. And then hopefully you get some refinance, pay out some or all of their investment back. I mean, it's a great structure for a lot of ways, for a lot of reasons, right? The passive partner doesn't have to do any work and they're able to own half of a great property and partner up with someone who knows how to do all of the stuff. They have the expertise. And the expert gets to buy property without needing to use any of their own money. So, I mean, that's the definition of a win-win for sure.
And it really does win if you're able to take the money that you would have invested in that and take it somewhere else and make those returns the same returns or like even close to those returns, right?
Yeah.
And obviously that's what I've been able to do either in the stock market, not today with GME. It's funny though, everybody I talk to is like, they're the only person I know that lost on that. And I'm like, thanks guys.
Well, it'll start soon. We'll see. It's not a game I'm getting into.
No, me neither. But for GameStop, for everyone out there watching. GameStonk, yeah. Jeez. Anyways, thanks, Elon. No, but and it's allowed me to invest in restaurants and other businesses and that type of thing, right? And I mean, you would never have gone to True Local because at the end it's a vegan.
Not a vegan.
Not a vegan thing. But yeah, it's allowed me to do other things. Whereas I would have been, if I was 100% focused on real estate, I probably wouldn't have got into that type of stuff yet. I mean, I know we had Mandy Brandam on talking about joint ventures being the most expensive type of money.
Right. Oh, interesting. Mm-hmm. Yeah, I think there's a couple ways to look at it, right? If you're trying to do a deal on your own, the way I like to look at it is, you're probably not going to scale up as quickly, right? You're not going to necessarily purchase as many properties quite as quickly because, in theory, you're going to be burning these properties a lot of the time. And therefore, it's going to take time, however many months in order to get the project done, refinance out the capital, buy the next property. But the idea being that, when you own 100% of a property versus 50%, you don't need to do as many deals in order to get the same cash flow, mortgage pay down, appreciation, all of that. The way I look at it is I try, in my situation, I'm happy to own 52 units and I compare it to the idea of maybe owning 104 units if I had joint ventured. The way I look at it in my head is I really like to be able to scale up a portfolio where I have, a lot of us get into real estate with the idea that we want to be under control of our assets, right? Mm-hmm. I mean, that's always the struggle. Like if I were to sell everything, I don't know what else I could put my money in that I would really feel like I have control over it. You could loan it out to people, but then you got to, there's a variety of risk factors there. You could put in the stock market, of course, comes with a variety of risks as well. There's always going to be a lack of control, but people get into real estate because they have somewhat of a control over that asset. In general, we don't have control over our tenants in Ontario so much, but otherwise we're doing pretty well. And if you are able to do it without a partner as well, then it's nice where you can, you could decide, I want to sell this property whenever I want. You don't have someone come and knocking on your door someday going, I need access to that money now because I want to take on some other project or whatever, and like you need to either buy me out or we're selling it. And it's like, well, I was hoping we were in this for the long run.
Yeah.
And it's a lot of like relationship management, right? If you structure your partnerships where, the thing is, a lot of people get into joint ventures not very intentionally.
Obviously pick the wrong partner sometimes too, but
yes, exactly.
Yeah.
So like people are oftentimes just getting a wide variety of joint venture partners rather than, being very intentional about, look, this is our joint venture agreement, being very intentional about the plan for this project, how we plan on structuring this, the way that you're going to approach it in terms of renovations, so that you're not in a situation where your partner's upset that you're renovating things they were hoping you wouldn't. They're expecting cash flow in the first year, where that's just not going to happen. We know as investors, most of the time it's not going to happen.
Yep.
Setting expectations is super important, and there is a right way to do with or without joint venture partners. We're often seeing a lot of the downsides to joint ventures in that people are approaching them wrong a lot of the time.
Wow, and they're picking the wrong people. I mean, they're picking people who have are working on their last $50,000, right? Like that's all they got in the world this is everything.
Yeah.
And so they're gonna watch that thing because if they lose that, then they're at zero.
Yes, exactly.
Whereas, if that $50,000 is part of their $1 million nest egg or portfolio of something, that $50,000 is just a part of their investments, right?
Yeah, like a perfect partner, I imagine, would be someone who, that's nowhere near all of their money. So there's that. They also trust you. They know that you're the expert. They're going to trust that the decisions you're making are the right decisions. And they also trust that you're managing it in a way that they don't need to micromanage you and make sure things are being done fairly. They're also the kind of partner who's probably just going to need an annual checkup, right? Like, hey, this is how the property's doing. They don't even necessarily ideally need to even visit the property. I mean, that's the kind of perfect partner for you, and someone that is also like under the understanding that you're going to own it for however many years and you're going to revisit it at that point.
Yep.
You don't want someone jumping out of the partnership at a time where you don't really want, you weren't planning on it.
Obviously, again, Mandy said that's the most expensive type. So let's just talk about, we've talked about joint ventures on here before, 50-50, different ways of doing it. But let's just talk about buying it on your own. Obviously, it's a little slower, but again, you control it. You control when to refinance. So if you want income rather than capital or,
right.
capital at that point, you can just wait a little longer. You can...
One of the benefits is that you can view your portfolio as your portfolio, right? If you have, however many doors and you got 4, 5, 6 different partners amongst those properties, you have to now choose which property you're working on. Like, say you have 3 units that get vacated. Well, which units are you going to work on at that time? Or you take on a new project, and this partner's upset that you're focusing on this project and not theirs, and things like that. If you own the whole portfolio yourself, you can leave a place empty for 6 months. The only person you're hurting is yourself, right?
Yeah.
And it's kind of it's like a bit of a relaxing mindset to have, right? Sometimes I'll have a project that sits because I'm working on something that I think is a better use of my time, and I don't have a partner to have to explain that to and relationship manage, right?
Yeah.
But one of the big challenges with doing this yourself is, of course, financing, right? The idea that you eventually run out of money, and like for sure, that's a thing. I think there does come a point, if you're burring properties well, and you're getting all or most of your money, or not leaving too much in every deal, there comes a point where you hopefully have, say you have 10 properties. There's a good chance that every year you're going to have 1 or 2 properties that you can refinance out something out of, right?
Yep.
You have a decent sized portfolio at that point. If you can refinance out enough capital to buy another property, every 6 months or something like that, your portfolio is now somewhat self-sustaining, right? You can refinance, buy another, and that's without even necessarily doing too much forcing appreciation, which of course should be the intention, but you can build some momentum like that.
Being an active real estate investor, if that's what you choose to do full time, it's funny, I had a conversation with somebody yesterday, and they were asking me, they're like, oh, should I get into like this type of stuff? And I said, well, you have a full-time job. He's, executive at a company, and he has 10, 12 like rental properties, condos, townhouses type thing.
Yeah.
He does some private placement stuff, some big money stuff. And then, he's invested in this with this guy out in Kingston, and, they developed a 70 bedroom student rental.
Oh, wow.
They like did an eightplex like Burr, and I was just like, why do you want to be an active guy? Like I don't want to be the active guy anymore. Like if you can just be the money guy, like I think it's the best deal out there.
I agree. I think honestly a big part of my thought process toward not joint venturing is actually more directed toward the active investors, right? Like for an active investor, if you're confident in your ability to refinance out all or most of your capital out of a deal, it may as well be your capital, right? If you're getting 100% of your money back out in 3 months, well, you may as well own the property 100% yourself after those 3 months rather than paying your partner back. And in that case, even if it's not your money, borrowing that money, it's nice to be able to build, a reputation for yourself where you can borrow money from friends or family or other investors or B lenders or whatever it may be. There's plenty of ways to finance deals without having to without having to give 50% of the equity away in order to get the project done, refinance out your money and own it 100% yourself when you're done.
Well, I mean, sometimes the cheaper money is paying that 10 to 12%, right?
Yeah.
Because you're going to borrow it for 6 months, 8 months, and then after that, they're out.
Yeah.
And you're paying whatever the stupid rates are right now, 1.6, 2, even if what are you refinancing at with the credit union right now?
Yeah, I think I've gotten between 2.4 and 2.75 with a credit union. And people are getting sub 2 all the time on the A-lender side of things. So I can't get Scotiabank mortgages anymore. I mean, that's definitely a topic of its own as well as when you're doing this yourself without partners, you need to be very aware of your debt service ratios as you're scaling because you need to be able to meet the bank's rules, whether that's a 50% rule or just understanding what their DCR should be. My credit union wants a 1.2 DCR or higher, and that's pretty typical amongst a lot of lenders. And you need to maintain debt service ratios in order for them to continue lending to you. So oftentimes you buy a property that it's under rented by half of what it should be rented for. It's very important to get turnover in that place, get the rents up to where they should be, because if you build a portfolio of too many of those, the bank's going to start saying no to you. Yeah. So it's very important to build a portfolio that the bank is happy to continue lending to you on.
I guess what's the answer? Is it joint venture or your own? I don't know.
My intention with a lot of this conversation is just to make it a conversation, right?
Yeah.
I think so much of what I'd seen over the last few years on social media and on Facebook groups and all sorts of that stuff is joint venture. And
you see the people who blow up, right?
Exactly.
You see Austin Ye and those guys and
Matt Pichet does
Pichet, right? And they blow up, right? Because they're doing joint ventures, and then they're raising money out there. And these guys, obviously, Matt McKeever, he's obviously their mini REIT type thing, right?
Yeah, they have 4 or however many partners. Yeah.
And, and they're out there raising capital to buy apartment buildings and do the same thing I do. But that's what you see people scale up quicker is you don't see the guy who's just in the background. Okay, I got 7, 8, 9 properties.
Because what reason does someone who owns everything themselves have to be on social media, right?
That's true.
And this was me for the majority of my investing career. Why am I on social media, right? It was years and years of me having just giving information and the benefit to me really was just being connected with so many amazing people, right? I'd be able to sit down and have a conversation with Mark and, feel like there's some legitimacy. And we don't necessarily need to even introduce ourselves because we've seen each other around. We kind of get a feel. And there's a lot of value in that. So, but most people don't recognize that value. So very few investors who own a lot of the stuff themselves, very few of them are on social media. So it's just a bias based on what people see a lot of because, of course, people doing a lot of joint ventures, they need to pitch their joint ventures. So they're going to be all over social media about it.
I was never until March.
Right.
No Instagram. I had Instagram, right. But it was tiny and I didn't do anything with it.
Yeah.
And then obviously YouTube and then I started getting into Instagram.
Yeah.
And, but until then, it was...
and
you wouldn't have found me.
Not a lot of people see the value of it unless they have something they intend on monetizing, right? But there's a ton of value in social media outside of monetizing. It's literally just about building connections with people, building legitimacy, skipping that whole introductory phase that you have with people. People already know who you are. You shake their hand and you can dive right into things, right? Yeah. It saves you a lot of time.
You can't shake hands now.
That's
looking back. You started about 6 years ago, 7 years ago?
I started in 2016, actually.
2016, so 4 years ago. Okay. Yeah. Looking back, would you do anything different? What would you do different?
That's a great question. I really don't do a lot of that looking back and deciding what I mean, the most obvious one is just I've heard this from the very beginning. When I first started investing, I talked to any successful investor, and the only thing that they ever really regretted was not buying more and not buying faster. And I heard that, and I went as hard as I thought I possibly could, based on my situation. And I bought 32 units in my first 2.5 years, solely owned. And I'm very happy that I bought as quickly as I did, because we've obviously seen what the market's been doing since.
Yeah.
And I've been buying throughout that as well, about 20 units in 2020. So I think that for most people, it's about buying as much as they can as quickly as they can, but focusing on the fundamentals, because we don't want to get into that Toronto investor mindset where you're just buying a bunch of condos and hoping they go up in value. I mean, you got to make sure these things cash flow.
Yeah.
I mean, that's your backbone, right? If we do see a market downturn, I haven't had the chance to watch all this stuff with Andrew Hines, but if we do see a market downturn, it's very important to have those fundamentals and something to fall back on in case of a market downturn, so you can ride it through.
100% for sure. Well, thank you once again. We're going to link your Instagram down below, because you're pretty prolific on Instagram.
I appreciate it.
I mean, are you ever going to do YouTube again? Because we could link that down below.
Yeah, you may as well. I'll jump on there for sure.
All right,
I got some videos.
If we get over 300 likes on this video, Kellan will do a couple of videos for us. All right.
Yeah.
All right. Well, thanks once again. Guys, if you did like this, definitely smash that like button, subscribe, comment down below. If you joint venture, if you're solo, or if you're just getting private money, let us know. Thanks, guys. See you in the next one.
Thanks.